Hi, welcome. Thank you for joining us today. Today we're going to be talking about how to optimize the payments experience for subscription businesses or subscription customers and why it's so incredibly important, how directly this knowledge is towards financial performance. So let me introduce myself. My name is Steve Arentzoff. I am the Senior Vice President of Marketing at FlexPay, and I've had a long career in technology marketing. And today we're going to talk about, again, the payments experience. And this is a topic that is often not well understood. Just the idea of the payments experience and the importance of it, but also why a bad payment experience is so harmful. One of the thesis and the ideas that we really wanted to walk away with today is the understanding that the payments experience really needs the perception of it within subscription companies needs to be changed from a transactional system or a transactional relationship that you really want to evolve that in the understanding of payments to relationships and its direct connection to customer satisfaction, customer retention, and customer profitability. And those companies that really understand this and have solved this have seen dramatic improvements in revenue, in customer retention, and profitability. And these are insights that any company can take advantage of and see very, very similar results. And one of the assumptions, and we talk about transactions and payments, is that the systems have been built as transactional systems because often the finance organization will go out and negotiate payment terms with the payment processors and try to minimize the costs. The operational systems are managed by IT, and they're just turning the crank and submitting payment requests and accepting the successful payments back. And it is operated that way because there's an assumption that the payment system overall works the way it intends to. It's accurate. And when we talk about a perfectly functioning payment system, what we really mean by that is that 100% of all legitimate transactions are approved and 100% of all fraudulent transactions are declined. Unfortunately, that's not the reality we live in. That's not the way the system works. There are gaps in the system itself. There are structural problems that the players in the ecosystem cannot solve. And as a result of that, these problems lead to a significantly high, surprisingly high percentage of authorization decision errors, particularly decline decisions on legitimate transactions. And this creates huge opportunities or huge problems for subscription companies, which we'll get into the root causes and what that means in tangible terms. So let's dive into this idea of what kinds of experiences subscription customers have with their brands. So there are really three legs that we view as the types of experiences that the customer interacts with. The first one, of course, is the product or the service experience itself. They use your product or service, they go on and they're happy with it or not. And we know that every subscription business invests enormous resources and time and effort trying to make this experience as positive as possible and make their customers as happy as possible. Very straightforward. Very also straightforward is the idea that when customers need help, when they interact with your customer support organization, that this is also an important experience. When those interactions with your customer support are positive, customers are happy, and satisfaction remains high, and retention remains high. But there is a third leg to the customer experience, which is the payments experience. And this is often, again, viewed not just as a relationship experience, like you've looked at your product experience, your customer support experience, but it's been built and managed, as I talked about before, as a transactional experience because it wasn't recognized in many cases as being so tied to customer sat and customer retention. So the payment experience is often either transparent and painless, which is good, or there's a problem and it's bad. And one of the key insights that you need to have, and we'll talk a lot about this idea that the root causes of most failed payments is not caused by the customer. They're not bad customers. They have opened to buy credit on the credit cards, but they're caused by payments, this friction in the payment system itself. So what that means is that when a payment fails, the customer is usually not to blame. And what also the insights is really important to recognize that even if a failed payment occurs, that doesn't mean the customer experience has to be negative. There are very direct ways that you can manage the customer experience. In many ways, you can make it invisible to the customer, which is what we'll talk about also. And I would even create the hypothesis, which I believe very strongly, the idea that across all these different experiences, a bad experience with the product is not great, and a customer support experience can be overcome. But a bad payments experience is going to be the most damaging experience to your brand and your customer satisfaction of all these three. Because when there's a problem with a payment, it's personal. It's interpreted that way. We all have experienced those times where we go in to make a credit card payments or make a purchase, and our card is declined. And the brand that declines the payment, even though it's been caused by the payment system, is the customer interprets that decline as, you're telling me I'm not good enough to do business with you. My card works everywhere else. I don't have problems with other businesses. I'm having problems with you. Why is that? And so that connection between your brand and your customer satisfaction is direct and immediate. And this is another very strong indirect cause of customer churn. So what we really want to drive home is to understanding that payments themselves are a strategic capability for your business. So we ask companies, the companies that have recognized this and moved to this idea that they have shifted their focus, their management, their attention, their investment of their payments processing, their payments ecosystem from a transactional back office infrastructure system that just everybody hopes it works, to a understanding that this is a strategic capability that is core to maintaining and retaining your customer relationships. So I've introduced the idea that there are declined payments and that there's reasons for the declined payments that are caused by the payment system itself. Let me go into a little bit of detail and bring that to life, because often this is not recognized by many people. So these stats and this data has actually been sourced from Visa. So we have very strong data sources which have been reinforced by our customers' experiences. But these numbers, well, they may vary for every company, are definitely around the averages what experienced by subscription companies. So what you see on the right is the definition of decline rates, payment decision declines by channel where the purchase is taking place. So if you walk into a store and use your credit card, there's a chip on it, the probability of fraud is incredibly low. We know that all the fraudsters are really done online. And the credit card companies know that. What they've done is create different risk profiles for the type of transaction. That is the information that is passed along whenever a payment request is made on a card. So in person, the decline rate on transactions is only 1%. The system is essentially working the way we want it to. But when you go online and card not present transactions, that decline rate average jumps up to 50%. And worst of all for subscription companies is that the recurring transaction, which is a specific type of transaction that the authorization systems that are used by the banks that issue credit card to consumers, where the authorization decision is made, averages 24%. And the reason for this actually is pretty sensible. The payment system, when it was designed decades ago, was built and implemented to support in-person single purchase transactions. Exactly what we see with in-person working the way we want. It was never designed for recurring transactions. It was never designed for card not present transactions, which is exactly the way the subscription companies work. So it gets even worse when we look at the data. So of all these transactions, the 24% average that most subscription companies experience, the reality is that 2/3 of those failed payments are not being caused by deadbeat customers. They're not being caused by credit problems. They're caused by false declines, which are decline decisions made on legitimate cards. So the card company has made a decision that there's a risk factor associated with that authorization request, and they would rather make a decline decision to avoid the fraud losses that could possibly occur on them, what they have to bear in the case it was legitimately fraudulent transactions. And so for subscription businesses, this is all bad news, but there's actually one insight that makes the news even worse and really reflects the true cost to subscription businesses of this problem. When we look at the 24% recurring decline rate, that's only measuring the single purchase transactions that are declined on a monthly basis. The reality is that for every declined payment that is not recovered, where you're not able to find a successful outcome with your customer, there is, by definition, churn created. So a unrecovered failed payment is actually costing you as a business all the subsequent payments that customer would have made, the entire amount of their lifetime value that they would have delivered to you. And so when we look at the 24%, unfortunately, what that really means in practical terms is that the financial cost to your business is much, much, much higher than what it seems like on the surface. So what's the way to solve this? And obviously, we'll talk a little bit more about the technology that is available and the opportunities to solve the problem. But probably one of the first places to start is this recognition that when you look overall in your business at the payments experience, you really want to, again, start perceiving it from a transactional problem or a process to a relationship opportunity, the relationship opportunity to manage and maintain and enhance relationships with your customers. And so what that means in practical terms is, again, we see that most of the declined payments are being caused by payment errors in the system. They're not being caused by your customers. So whenever there's a failed payment, some companies will look at that and say, I'm going to go reach out to my customer and ask them to help me solve it. I'm going to force them to solve a problem that that customer didn't create, which of course puts the onus on the customer. And every time we know that every time a customer is exposed to a failed payment, it creates a moment of truth for that customer. They are going to be forced to make a decision if they want to continue with that subscription or not. They can decide, I can't afford it anymore. They can decide that I'm not getting value from it. They can decide maybe there's another company I want to work with because I haven't had problems maybe with them. And so this moment of truth that's created is either they choose to help you recover the problem, this failed payment, and that relationship continues, or they just passively don't help you. And so what that does, that's, again, the key source of the involuntary churn we see created by failed payments. So the better outcome is when there is a failed payment, always try to resolve the failed payment directly working with the payment system, because that way, as far as the customer is concerned, it's solved invisibly, and they never even know that the failed payment occurs. So that moment of truth never is actually created. And lastly, we see some companies that have taken the approach that whenever there's a failed payment with their customers, they view it as a credit problem. They actually kick off dunning and collection outreach sequences through phone calls and emails and text messages. And that probably is the worst possible action to take, where you are actually, again, accusing your customers of causing a problem. And there are going to be times where you do have to create an interaction with your customer. Our solution called Invisible Recovery does work directly with the payment system, but it won't be able to recover every failed payment. There are times and cases, for example, if a card has been canceled because of a fraud outside of your business, that card not work, you will have to interact with that customer to get a new card. On the other hand, instead of confronting the customer with a credit problem, taking the mindset that we want to collaborate with our customers, we want to reach out to them empathetically and help work with them to solve the problem, where they understand that they're working in a partnership with you to deal with this problem, is a much better outcome. So all these different philosophical changes and approaches can change the mindset that is a transactional process into a management of relationships process and outcome. And this is so important. It's so important to understand. It's so important to solve, because as I introduced the idea before, the reality is that the cost of failed payments is much higher than a single payment. Every time a payment that is failed is unrecovered, again, you've lost the LTV of all those future payments that customer would have delivered to you. And so what that does do is create the insight that when you create failed payment recovery processes and systems, the focus has to be not just on recovering the transactions, but also doing so in a way that really optimizes the life cycle after recovery, maintaining retention of that customer, and actually starting to measure that so that you can understand whether or not you're successful or not. And lastly, the way that this will be measured is LTV. I mean, we'll talk about the calculations and give you some guides on how to do that yourself, but that success in recovering failed payments is measured over time by the duration of payments those customers that recover from the failed payment are delivering back to you. And that while it's important to measure recovery rate, it's important to measure the short-term revenue that your failed payment recovery system is delivering to you. That is not the way you ultimately want to judge your success. It's by the LTV of the customers that continue to bill for 10, 15 months after the recovery occurs. And so within FlexPay, we look at this very holistically, and we actually have optimized our system to work across these three dimensions. So we talk about this idea that optimizing recovery within the failed payment problem has to be designed to maintain long-term relationships with your customers and the banking systems. So the first element of that is maximizing, of course, the failed payment recovery. It's incredibly important. Customers that unrecovered, again, we know we lose the LTV to those customers. However, we really want to make sure that our system is designed to maximize the retention of the customer and the LTV of them through the system, again, which is why our Invisible Recovery solution is designed to interact directly with the payment system, because we can do that in a way where the customer, if that process is successful, actually eliminates the customer visibility of the failed payment, and the natural life cycle of the customer continues. Similarly, and this last point is just as important, which is the failed payment system you build out has to optimize your merchant account health as well. And this may not be an intuitively obvious conclusion, but the reality is that your merchant account risk score, and every merchant account has a risk score that the authorization systems look at, is actually impacted, for example, by the number of retry attempts you make on failed payments. So if you start to use systems that generate large numbers of retry attempts, just automatically kicking off retry processes in a misguided belief that this is beneficial, what's going to happen is that the banking system will slowly start to create a higher risk score around your merchant account, which ironically leads to higher rates of failed payments because your risk score increases. So optimizing that failed payment health really means that you don't want to brute force the approaches. You want to minimize the number of retry attempts and do so in a way that really delivers returns on your recovery, but does it in a very quick fashion. And this is why it's so important to really understand the risk factors that go into your merchant account score, because it gives you insights and gives you ultimately control over how to improve that, which not only helps improve the recovery rates, but ultimately helps avoid upfront declines in the first place. And what we see is that the customers, those businesses we have, our customers that really have earned the highest delivery of both recovery and retention, understand this and actually give us all their transactions of failed payments first. They don't try to run any internal processes that they built out. They don't send over failed payments to customer service first. They use the systems that are optimized to both deliver the highest amounts of recovery, do so in a way that's invisibly, and then when there is opportunity to engage customers, do so in a way that's actually empathetic so that we can optimize the customer satisfaction and ultimately their retention. So again, I recommend to everybody that if you are evaluating any failed payment recovery solutions, these are important questions to ask. For example, what are your recovery rates on average? What can we expect to see? But what are the retention rates of customers that are recovered? How do we measure those? And ultimately, is your system going to introduce risk and higher failed payment rates down the road because of the way the system works? So we know, and we've gained a lot of insights over the last few years about the relationship between payments optimization, this migration from transactions to relationships, and actually how it connects to financial performance of subscription companies. And we've talked now to thousands of businesses. We've done this through proprietary research and through our own data analysis and conversations with customers and prospect companies. And we've been able to actually create 4 cohort groups of subscription companies based on their processes, their outlook, their cultural norms, and what it means for their financial performance. I'd like to go through those now. So at the bottom of the pyramid, we have the companies we call the blind acceptance of the payment systems. What that means is that often these companies just accept that the system works the way it does, and the outcomes that they're seeing are simply something that is. They often will blame their customers for the problem. They will say things like bad customers spoil for everyone, our customers are subprime and they're bad credit risk. And so they have a blindness to what the opportunities are to solve the problem. And we see often that the words that are used to describe their financial performance is that our processes are broken, we have burning financial issues, and we're getting left behind our competitors. These are all, of course, very negative attributes to associate with the company, but the reality is that this connection between how failed payments and payment problems and the payment experience and the understanding between transactional and relationships is directly tied to this. So the key and the continuity across all companies that sit in this bottom tier are the ignorance, right? The ignorance of that the system is not perfect and that these problems can be overcome, and accepting that and starting to address that and deal with it. So above this base layer is probably where most of you sit. And they're the 2 levels that we find that a significant percentage of subscription companies sit in. The first level above the blind acceptance or the red tier is the amber tier. And these are companies that are at risk. The good news is that they often will recognize that the failed payment problem occurs. They also recognize that the credit card payment system is the path to value, and they put some effort trying to optimize that. But they still view payments, they view that this whole problem as a transactional problem. And what that does, of course, is not only put their financial performance at risk, but it puts their customer retention at risk. And the words that we see coming out of those companies are, yeah, we view our problems transactionally, our financial performance is marginal, and we're barely matching and keeping at pace with our competitors. On top of that are companies that sit in the blue zone, and these are companies that are actually mostly in pretty good shape. They are investing usually a significant amount of efforts in resolving failed payments, but they are also structurally limited because often they're still looking at this as a transactional problem. They are limited. We call them structurally limited because they're often working with the misguided belief that the results they're seeing, if they put a lot of effort in solving the problem, are the best that can be achieved. And in a positive way, we look at the results as being durable. They're delivering healthy financial performance, the financially respectable profitability margins, and often they are ahead of their customers, but they're still not reaching the top tier, which is the green level. And this is where we really want to have every business perform, because the reality is that these problems can be overcome and they can be solved, and every company has the opportunity to jump all the way up to this top tier, which we call relentless success. And the key insight here, again, is the connection between payment systems, payment experience, and the relationships with their customers. And the words that we see that are associated with companies that have solved this and gotten this level of success are: we have effortless financial performance. We have unlocked tremendous value for our shareholders and for our customers because we can improve and invest the entire company across the board. And our financial results, our profitability has become accelerated. I think any company would look at this and feel like that's exactly where I want to be. It's such an important factor to be able to understand. And one of the other secrets that is unlocked by the companies that got, to some degree in the blue, but definitely in the green section, is that the results of recovered customers continue to deliver acceleration of growth, right? There's a cohort group that may recover this month, and if they continue to build month after month, we have this month a group of customers that have been recovered, but next month we have that same group continue to build, plus the new group. In the third month, we have this cohort group stacking up, and then really that compounded growth is a dramatic, in fact, it's probably one of the largest growth accelerators that subscription businesses can earn, and they can do that in a way that actually, again, delivers very, very high profit margins. So we know that optimizing failed payment recovery, optimizing the payment experience, connecting the dots between the payments experience and relationships powers financial performance and powers success of companies. And this idea that this is not revenue that looks like the revenue you have now is also one of the most important concepts I really hope you understand. You think back now at the cost of acquisition for customers. We know from the economic headwinds, possibly we run into recession next month. We have a lot of data that indicates that across the subscription category as a whole, growth has not only slowed, it's actually gone down. So most subscription companies that we work with have seen not just decrease acquisition rates, but actually the cost of acquisition has increased as well. It's been hard to acquire customers. So when you acquire a new customer, the profit of that customer has to be overcome by the cost of the acquisition. Most companies will see that the cost of acquisition typically equals 3, 4, 5 billing cycles. So you have to have a customer around that long before you even start to break even on the cost of acquiring them. That's expensive. Now, the reality is that the revenue from a recovered customer costs a fraction of that. And so that customer is wildly profitable in month one, but all the revenue that's driven in the compounding delivery of their continuing successful billing cycles is 100% dropping to your bottom line outside of your gross margin, of course. So the revenue from recovered customers is more profitable revenue. And that's what we talk about, this idea that solving this problem not only delivers higher growth rates, but actually powers accelerating profitability rates as well. And again, we ask you, imagine, what can your company accomplish if your financial performance outpaces your competitors? What we mean by this is that the system itself is the way it is. There's a status quo that every company has been operating in. This problem affects every single subscription business to some degree because the system itself is the cause of the problem. It's systemic in the payment system. And this is creating equilibrium that every subscription company works within, and it affects the profitability, it affects the revenue, it affects the customer retention. We believe it's such a big problem, even though awareness is slowly growing. It's such a big problem that every subscription business will have some system in place, some solution in place in the next couple of years. And that will reset the equilibrium in a positive way, which is fantastic. But imagine if you're a company that recognizes that the challenges exist now and you deploy strategies now. What that's going to mean is that you're going to unlock higher growth rates than your competitors. You're going to unlock longer retention rates. You're going to unlock more profitability. That gives you the opportunity to reinvest in the business or use funds in different ways. You can make choices to invest more in company growth to gain market share. You can invest in your product experience to increase overall customer retention or satisfaction, which leads to higher rates of retention, which again creates a self-fulfilling positive loop of improving revenue and profitability. So it gives you choice. It gives you opportunities to reinvest in the business that your competitors just won't have. You can create a competitive advantage that opens over a window of time before your competitors catch up. And it really gives you an opportunity to outpace your competitors. So what we find most companies do to get started, while they start to understand these concepts and become interested in them, is the starting point that we found with most of our successful customers is starting to understand what the problem means for themselves. And they may intellectually understand that we do track maybe in our failed payments, we may even track our involuntary churn rate, but understanding the full cost is often not understood. So there's steps we recommend. First of all, start with your involuntary churn rate. What that means is look at your failed payments and understand how many of your customers that are being lost are being lost due to an uncovered failed payment versus the customer voluntarily ending the relationship. That is your involuntary churn rate, the percentage of losses of customer churn that's caused by payment issues. Secondly, calculate, of course, how many missing payments from the customers, that transactional loss that involuntary churn is causing you. The starting point, though, it's not the ending point. The ending point for that, understanding the problem, is looking and calculating that what is the LTV of those customers that are lost. It's a fairly easy calculation. You know your average retention of customers, how many billing cycles are active, and you know when customers are lost in their life cycle. And you can start to actually forecast out for every customer lost involuntary churn, what the economic value that's been lost as a result of the involuntary churn. So you do that and you add it all up, and that gives you a understanding of over a period, your period, the total losses to your business from involuntary churn. And I can guarantee it's going to be a very, very large number for your business. And of course, once the proper recognition of the size of the problem, the scope of it, and the pain that's causing you, it does lead often to a prioritization to solve the problem. To go out and we recommend, of course, implementing a specialized recovery solution. And of course, we think that our system is the best. So we recommend you looking at our system. And once you implement a system, certainly start to measure the LTV of recovered customers. And that'll be a really proper way of measuring the true value of what that means. We've tried to make this easier for you. There's a QR code on the right side of this slide. And if you use that, it will take you to a document on our website that will allow you to give you guidance on what data to pull in and the calculations to make to start calculating your involuntary churn and the LTV losses from involuntary churn. I certainly recommend you take that step. It's a guide that you can run yourself and work with your internal analyst to accomplish. If you're interested, though, for anybody on the webinar, please reach out to us or put your name into the chat. We will then come follow up with you, and we certainly are willing to lead you through the process and give you guidance. In fact, if we'll even offer up a special offer for anybody on this webinar, we'll even run the analysis for you if you want to send your data to us. Our customer success team can run the analysis and give you your number back for you. But I really, really recommend strongly for every company, go through these steps, calculate these numbers, and start to look at the problem in this way, because I can almost guarantee you're going to have a eureka moment. You're going to reach a point where the understanding of the total losses of the problem is going to be calculated, and it's going to be shocking to you. Well, thank you very much. I hope you enjoyed today's content. I do see we have a question from John, one of our attendees. And John has asked the question, I see he's going back to the pyramid that we showed for the different types of companies and their status and recognition of financial performance. And John asks, what is the most common attribute that you see that associated with companies that are in the green tier, the top tier? It's a great question, because obviously, well, there probably is not one factor that leads to companies reaching the green stage. To give you a little bit of a preview, we just wrapped up and completed a report that's going to be issued in early January, a benchmark study comparing hundreds of subscription companies. We partnered with the payments organization to do this. And one of the insights we gained was that 100% of companies that are in the top tier financial performance, subscription companies, were using specialized third-party solutions to solve failed payments. The rate of companies that were using it in the bottom tier was less than 3%. I think that's probably the best answer I can give, is that the recognition of the problem and the recognition that the solution really is going to be, that's going to give you the best performance, is work with a company that really thinks about this problem every day, 24/7, 365 days a year, and is continuously driving innovation on finding ways to be able to optimize recovery because of the impact it has on revenue, both in the ability to recover more transactions and retain customers longer. So that insight that all the companies that are in the top tier from this study were using specialized third-party solutions, I think is a very powerful conclusion, that the companies that have recognized the problem and have moved beyond trying to solve it themselves are seeing outside financial performance results. Okay, I see that's the last of our questions. Thank you very much for joining me. It's been a total pleasure. If you have any follow-up questions, please feel free to throw them out. Reach out to us. You can reach out to me at FlexPay. My email address is sarentzoff@flexpay.io. Again, thank you very much for attending, and it's been a pleasure.